Hey, welcome to the Amy Roundtable. Today's the 5th of May, 2021. Special guest today, Tim Pierson, who's taking over the Boxcar Trade Alerts from Amy Meissner and Dan Harvey, who created the Boxcar Trade. So welcome, guys. Nice to have you here.
Hi, Tom.
Hi,
And
Tom.
yeah, before we get too far into it, just a normal disclosure, Airmer is not a broker-dealer or an investment advisor. This is for educational purposes only. Options, futures, bonds, and currencies involve risks and are not suitable for all investors. Past performance is not necessarily indicative of future results. And if you want to read the whole thing, just pause the recording if you're watching that, or go to the bottom of any of our web pages and read the whole thing in its full glory. So with that, I'll turn the webinar over to you, Tim, and I'll be here as well as Dan to answer questions or add our 2 cents as we go.
Okay, sounds good. Yeah. Well, I see a lot of names in the attendee list, 34 people. That's great. Who are probably coming from the boxcar service that Amy was running, and some names I don't know. So I want to introduce myself a little bit and then talk about how I might do the boxcar trade service from here on out. So with that, I guess I'll just dive right in. Tim Pierson, I first traded options in 1987, just before the crash, and I had some puts on. I actually made money in the crash of 87 on Coca-Cola, if I remember right. So come a long way since then, but I didn't trade much for about 20 years, and then back in 2009, that's something else. You can ignore that. Back in 2009, I got back into options trading in a big way. I went through a mentoring program and learned everything I could and read a 2-foot high pile of books about it. Then in about 2011, my results were good enough and the time was right for me to leave the day job and do full-time trading. So since 2011, I've been trading options, and that's all I do. Some of you may know me. I'm one of the 2 inventors of the parking trade, which got really popular. It's a very simple trade, but it got really popular, and I traded that a lot and made a lot of money off the parking trade, but I haven't traded it too much recently. I ran the road trip service for a while until about last June. After Dan and Tom wanted to stop doing it, I took it over and ran it for a while. We've closed that because there weren't very many subscribers left, and road trip isn't being traded too much lately by me anyway. As you might have heard, I run the beginner trading group on Thursdays, where I spend an hour every Thursday going over some subject and trying to explain how options work and how strategies work and how you should trade. And I often show examples of my own trades in there, and it's been fun running that for the last 8 years, I guess. Boxcar trade. So I've been trading boxcars since July. I decided back then I was going to try and make that be my bread and butter trade since I wasn't doing the road trip anymore. I have made 34 boxcar trades since then. Across all of them, I'm net positive P&L. And rough sketch analysis, I'm up about 24% on an annualized basis since I started doing them back in July. The rule set and guidelines that we use, I'll talk about that more, have evolved a little bit, and so we're trading them a little bit differently than we were back in July, but it's all good, and even the old rules can still be viable rules. And then I guess lastly, quick introduction on Boxcar. I recently did 5 boxcar trades in the last week on paper. I didn't do these for real as a test, and all 5 were profitable, with a few adjustments using the guidelines that we're currently using. I also had a live one that I closed this morning, and it made about, if I remember right, 2.8% in about 6 days. So, but it was a wild ride. I had to make upside adjustments and downside adjustments, and but in the end it worked. So I guess that's the quick introduction about me. Let's see. Is this being recorded? It is being recorded, right, Tom?
I believe so. Let's see. Yeah, it says stop recording. So yes, we are recording.
And if it is, will it be made available for review on Airmere? So that's, I guess, the question. Is it going to be for the Boxcar subscribers or going to be for anybody that wants to look at it?
This is a roundtable, so I will actually post this in the members library and also on YouTube.
For everybody to see?
Yep.
Okay, great, great. So that brings up another question that has come up in the last week or two with Amy. You know, she's leaving officially. I'm taking it over on Friday this week, but she's made her last trade, so there's no new trades that she's doing right now. But one of the big questions was, will all the recordings, the weekly reviews that she did and everything she's recording and all the images and history and everything still be available out there on Airmere for people to look at?
I don't see why not.
Okay. Good. That was a big question when we were talking with Amy. So great.
Now the only thing would be the trade performance is going to change because it's Amy's boxcars versus yours. But for now, I can just keep them there, and then at some point, if we want to just reset it to where you start, like today, we can do that. But initially, I won't do that.
Okay. Right. Okay. Well, I'll be tracking my results anyway, and so we can retroactively do that if you want to as well.
Sure.
Okay, so everybody, I want to talk for a few minutes about how I plan to run the service. Now, technically, it's an educational service and an alert service. What that means is that I will send out alerts. I'll be making the trades that I do. They'll be my trades. They'll be my live trades, and I'll be sending out alerts when I adjust it, when I take them off, when I open them, all that stuff. And I'll do that in real time as I make adjustments and so on. I plan to continue weekly review like Amy did. She did it on Mondays at 1 o'clock my time. I'm not sure what time I'll be doing that. And in fact, I guess I'd like some feedback from the subscribers as to what times work well, for them. But I'm considering doing it Monday mornings, maybe around 10 o'clock my time, something like that, 9 o'clock, but I haven't decided yet. So we'll figure that out and get that announced pretty soon. But I'd like to hear what works well for people.
And we can deconflict that with the other meetings too.
Yes, right. And I will continue to write updates. I may not write an update every day. These are the updates that are written on the top. When you log into Airmere, you get a section at the top that says any updates that came from the services that you subscribe to.
Like the planning notes.
Planning notes, yes. Sorry,
Yeah.
Thanks. I forgot what we called them.
Yeah.
I will continue to do that. I may not do it every day, but probably at least once a week and probably twice a week. As well, I'll continue what Amy was doing, where I'll put images out there on the subscriber page of my trades and what I've done and maybe some comments. I don't use ONE or option view, so the images will be made from Thinkorswim, which means they'll be done in real time when I do them. And we may do a roundtable once a month or something like that. Those are my plans.
I mean, like for the subscribers.
Yeah, exactly.
As a roundtable is like a public one, so that would be like a subscriber-only webinar.
Oh, okay. Maybe it should be called something else, but yes, I do plan to do that. This is all the same way I did it when we ran the road trip,
Right.
Okay. Technically, it's an educational service as well as an alert service, and what that means to me is I'm going to be completely open about the guidelines that I use, the thought process about how I choose strikes, for example, and I'll be communicating all of that in the various means that we have. I don't plan to hold anything back for the subscribers, and over time we'll have gone over everything. That's going to be something different. I don't, some people want to not say how they're doing it, considering that the secret sauce, right, that they use to make their trades. And
Right.
I've even done that in the past, but this time I'll be completely open, and my intention will be to educate everybody on exactly what I'm doing and how and why. Um, as far as the guidelines I'm plan to use, I want to be what I call, I hope, Dan, I hope you don't mind I say this, but I want to be what I call 98% Dan. What I mean by that is, Dan has talked on Trading Group 1 and with Amy and in the service and other means just about how he trades the boxcar, and he's outlined a lot of his guidelines and rules and his thought processes and how it's designed and everything. And I plan to follow maybe 98% of all of that. What that means, for example, is I know Amy was putting calendars on as an upside adjustment in some cases. And I agree that this trade does need an upside adjustment, maybe even more than what the guidelines are. But most of the time, I probably won't be doing calendars as an upside adjustment. Now, with that said, I reproduced a trade that was done in the class, and I did it without doing the calendar adjustment. And under those particular conditions at the time of that trade, being using upside adjustments simply to peel off debit spreads, produced just about exactly the same P&L results as it did using a calendar as an upside adjustment. Now, different conditions, it'll be different, but I do believe that the guidelines we have, which is peeling off the debit spreads as an upside adjustment, are good and will work. And I will consider other upside adjustments, things like call credit spreads, which are dangerous. You have to be really careful and judicious about using those. I probably use those very sparingly as well. Possibly rolling up the bottom put credit spread. There'll be other things that I'll be doing that are in the toolbox of tools that we use to manage this trade. For anybody who may not know, Gary Whitlock and Dan and I are developing something that akin to the G tool that was used for the road trip. I'm not sure what we'll call it. I suggest we call it the B tool for Boxcar, but anyway, Gary's doing some wonderful programming that will analyze and rank different possible entry trades and produce a report probably once a day, sometime in the morning, that people can use to look and see where their strikes should be, all the metrics that determine where the adjustment point should be, all the guidelines and everything. Gary's coming up with some wonderful programming that will help quite a bit on that. It'll help mostly with the entry, a little bit with the initial adjustment points, and it'll show you things like how well the trade's expected to work and all that. That's going to be coming out sometime soon. It's not released out yet. I believe it'll be an add-on subscription, but I don't know what the details are going to be about that. I'll be using it to help my entries, overlaying my guidelines and experience and method on top of it. So I may start with whatever's recommended B tool and make some adjustments to the strikes if I think it's necessary.
So Tim, I'm also, as you may know, working with Gary on the B tool. In fact, I corresponded with him just this morning, and I know you've been working on it as well. And
yeah,
I just wanted to point out that not only will the guidelines be similar to those that were used in the road. Well, let me rephrase this. The formatting and the concept will be similar to that of the G tool that we used in the road trip trade. And so they will include some suggested trades. And I asked, again, Tim, you may or may not have weighed in on this, but I asked Gary to rank the trades according to the profit targets at a specific point, which is what I call the hump, the T+7 hump. And I'm just now discussed with him a point at the same price of the underlying to show the loss that you would be expected to have at that hump point, on a day, 7 days from now. So in other words, that was an awkward way of phrasing this, but there should be some, hopefully it'll be formatted such that you can see ranks at the expected or the projected profit at T+7 maximum, and also at that same point, the expected loss if it was not going your way. And that'll give some clues as to, when to bail out or however you choose to run that aspect of it. But there'll also be the contingent orders, which I personally, and I think you do too, Tim, the contingent orders that I place right after the trade has been filled. And that way I can sleep a lot better. I know that something will be taken out if we have a sudden move, and then I can go from there. And that's what I've been using to have really good success. I just now took one off here today. I made about $1,200 in, I think, a week. And of course, it's going to be a larger size, I think, than what you're using. But it wound up being about 6 or 7%. So I think Tim's approach, which is also my approach, to peel off debit spreads and credit spreads as necessary, I personally think that's the way to go, both in terms of profitability and also in terms of simplicity and the ease of getting in and out of the trade.
Yes. It's excellent analysis. It will also, by ranking different possible trades, you can rank them and choose which one's the best, for you. I like that a lot. And it also give a relative indication of the safety of the trade, I guess I would say,
Right.
Yeah. So I haven't caught up on all the exchange this morning yet, but I'll be getting into
there's
that
some
later.
questions. I mean, they're asking, I'm looking at the chat. I know you can't see it at the same time, or because you're busy talking and teaching stuff, but it looks as if they want some information about the actual guidelines, which will have changed, I think, somewhat, perhaps even significantly from the way that Amy was doing it. We have some metrics now that we use, which Tim will explain, I guess. You're going to do this about the debit spread, credit spread, or I should say the credit spread, debit spread ratio, and that sort of thing.
Yes.
So I'll turn it back over to you, Tim.
Okay. Thanks, Dan. Yeah. I wasn't looking at the chat. There's a lot of them. Okay. So, well, let me go on through my notes and then we'll address special questions. So Dan's exactly right. I was going to talk at least a little bit here about how I'm going to do this. So initially, I will plan to do one trade a week, just like Amy was doing, with about 3,000 in margin as starting margin. We need to plan for this because if you peel off debit spread adjustments as an upside adjustment, for example, it raises the margin. So the trades need to have a starting margin plan for and a maximum margin plan for, and I'll be doing all that through the guidelines. Then I plan soon to, and initially this will be an SPX, just like Amy was doing. Soon, hopefully within maybe a month, I plan to start doing some trades in the Russell as well. When I do that, we'll have up to 2 trades a week, and we'll still control the margin on each individual trade like we did. But I wrote in my notes, if possible, okay? And I wrote that because one of the guidelines we have for doing these trades right now is open interest on the contracts that you're going to use, the strikes, there needs to be some open interest, not zeros. And if you look in the Russell, there's a lot of strikes that have zeros or 2 or 3 or 5 or 10 open interests, and we'd ideally like to have more than that to get good executions and get good pricing and all that stuff. So I wrote, if possible, especially the Russell weeklies, it gets kind of hard to meet that guideline. And the trade may still work, but it gets hard to meet that guideline. So working on that. And then over time, again, I hope in a month or maybe two, I plan to increase the margin used on each individual trade, because if we have like 3,000 in margin and we make say 5%, that is $150 a week. Okay, it's 5% a week, but it's $150. You know, it'd be nice to make 1,000 a week kind of thing. So the only real way to do that is to have higher lot size and higher margin out there. That said, this trade, especially the way we're doing it now, the 98% Dan way, I believe will scale up or down quite easily. And the webinars and service, I'll be talking about that a lot as well. So if you didn't want to trade 8,000 or 10,000 margin, you could scale it down easily to 2,000 or 3,000, I believe. And I may even make comments on that. I'll try to make comments on that when I open trades. Days to expiration. Usually I'll do about 10 to 15 days. And this is kind of, Dan, I think how you're doing them now too, somewhere around 10 or 15 days to expiration when you open.
Right.
Yeah. Amy has been doing them a bit shorter, like 7 days, and I've done quite a few of my own trades at 7 days, and they can work. But with a little more time, you have a little more opportunity to make adjustments and manage the trade, and they can still work fine in 7 days or less. You know, those paper trades that I talked about were 10 or 15 day to expiration trades. When I open them, they all still produce their results in 5 to 6 or 7 days. So it doesn't mean you be in the trade for 2 weeks. It could mean that, but it doesn't usually mean that, and the trade will still work.
I think that's right, Tim. I'm actually usually only in the trade about between 7 and 10 days. I just would point out, and maybe you're going to discuss this a little bit later, but yeah, I've always referred to this trade as what I call a mathematical trade. And what I mean by that is you're receiving credit, credit to your account from the put credit spreads that you sell, and you are hedging this with the debit spreads that you buy. And the ultimate profit or loss which you achieve on the trade will be determined by the relative interplay between the two. So that, for example, if the credit spread is making money, the debit spread is losing money, and the converse. And so the adjustments simply seek to balance those such that you maintain a good, healthy, positive theta with minimal risk as monitored by the Greeks. And when you hit a profit target or approach it, you either scale it down or you take the whole thing off and you take your money and go buy a hot dog. The reason for the 10 to 15 days is the corollary of what I just now said. Being a mathematical trade, it's also a probability trade. So if you go out a little bit farther in time, you can get a little farther out of the money, and this will help you should the market suddenly begin to tank. So that's all.
Yeah, that's exactly right. And yeah. Okay. A couple more notes, and then we'll get a lot of questions. I know that Amy had done some stocks, boxcars on some stocks, and she hasn't done that for some time. I think it was 6 months ago or something. I don't plan to do it on stocks either, at least for some time. Maybe in a few months, and if the markets are conducive to it, we might try some stocks. But one of the problems was stocks can move a lot more in percentage terms than the indexes can, and quickly when they do it. And this is one of the big reasons why she was using calendars on the upsides, is to help control those large and quick moves that the indexes typically don't do. I mean, yeah, they make some large and quick moves as well. So I don't plan to do stocks for a little while. And then I want to talk about the good till cancel orders, like Dan brought up. Every time when I open a trade, I will be entering good till cancel orders for the UAP, which is my abbreviation for upside adjustment point, and the LAP, which is my abbreviation for the downside adjustment point. And those orders will sit out there until one of them is filled, and then we'll reevaluate where the next one should go. But Dan's exactly right. Those orders will help manage this trade and make it more profitable in the long run by basically automating the adjustment points. But that said, I just want to point out there are some differences in brokers. Now, Thinkorswim, it's real easy to do. I do some of these trades at Schwab, and Schwab lets you do good till cancel orders, but it looks like it's only single leg options trades for a good till cancel conditional order like that. I need to call them on this and ask them and find out the details, but it doesn't look like they'll let you do a debit spread order, for example, as a conditional order on options. And other brokers may have different ways of doing the good till cancel orders as well, so that you'll need to be sure if you're doing this to understand how your broker handles those kinds of orders. And I guess my last note here is that one of the big things that we use to choose adjustment points and choose management of the trade is the day step curves, which Dan uses a lot. It's an excellent way to look at it. I'll be doing that as well, and we'll be talking about that in some of the webinars and all, so you can understand how we're doing it. Those are my notes. Maybe we'll see if we have questions or comments.
Tim, I wonder if it would be helpful to, just for kicks, set up a trade, not to get it filled, but simply set up a trade, and then perhaps you could discuss some of the guidelines that you'll be using, and it will make more sense when they see a potential trade in play, you know, particularly with regard to, say, the credit spread, debit spread ratio.
Okay. So here's SPX. Let's see. Hold on just a second. So we have a comment from Victor. With the recent wild fluctuations of 80-point rep moves and 50-point SPX moves, do you believe this is still a viable trade?
Yes, absolutely. Because that trade I just now mentioned, that let's see, I'm looking at my I'm looking at my spreadsheet right now. I actually made $1,350 on that. And that was a trade that I launched on the 26th of April. That 1,350 was nearly 9%. Now that was on a maximum margin of 15,000, but you can scale it up or down accordingly. And my point is not to say whoop-de-doo, but my point is that I was in this trade during some of the fluctuations. And the debit spread is a hedge, remember. It's not a perfect hedge. There is no perfect hedge, but it's an excellent hedge. And with the management rules that Tim is going to give you, let me put it this way. The only things that I'm doing now in my own personal account, I'm doing boxcars on the SPX and the RUT. I'm doing a single day trade options on the SPX, but those are day trades. And then I have a little bit of money in Wayne's Sleepwell. That's the only thing I'm doing right now. So I'm obviously a believer. I know I'm biased, but I make money with it, which is, I think, our goal here.
Yes. Yeah, and those debit spreads can really pay off in a big drop. So yeah, that's exactly one reason why it's still viable. Will I be posting updated set of guidelines and rules similar to Dan's guidelines? We're not going to call them rules. They're guidelines. There's no hard and fast rules. Similar to what Amy posted a year ago. Yes, I will. And over time, we'll be going over all of those. Are we supposed to view Thinkorswim? Yeah. We did the disclosure in the beginning of the recording. right now you're seeing Thinkorswim and we're going to work a trade up here. Yeah, okay. Just trying to catch up here for a second. I have original guidelines. Okay. Where you want the put credit spread to cover approximately 60% of the cost of the put debit spread. Is this one of the guidelines or have the rules changed? Dan, do you want to comment on that?
Well, Tim, I think if you get a trade set up, and by the way, you have the SPY up there, not the SPX, but I think if you get a trade set up, we'll see the credit spread, debit spread ratio. I think it will address that question.
Okay. Great. Okay. Waiting for Thinkorswim. Peeling off spreads wasn't part of the original guidelines. Okay, I don't know, but that's a big part of the guidelines now.
Well, I don't know if Amy incorporated that, but I certainly discussed it with Amy because it was what I've always done. I mean, I'm basically trading this now the same way I traded it 2 years ago or whenever I came up with this little puppy. So I've always used that.
Okay. Quick question. New to looking at options so deeply as well as the risk graph. Would you
I
recommend
answered that.
Oh, okay. Okay.
But we can comment on it again. Sure, SK, it's always good to read everything, but that's going to be labor and time intensive. I think one better approach would be just to get a fundamental bird's eye view of the way that options work. And secondly, to become extremely familiar with whatever platform you're using, particularly with regard to the option chain, et cetera. And then, as I said in my comment, follow a couple of Tim's trades, and some questions will come up that you can then either read about or perhaps discuss with Tim on a meeting or a chat or something.
Yeah.
I think you might be better served than to get 5 books on options and start reading. And the reason I say that is been there, done that. Because I started this in 1994 when there were no mentors. There were very few books. And so, I've gone through all that, learning from the seat of your pants. And you're better off just to try to learn about the things that are coming up.
Yeah. Yes. Okay, one more quick one. If we'll be 7-10 days, is there a chance to overlap? Yes, there is. And especially if I get Russell going, there will be some overlap. If I'm just doing SPX, there might be, hopefully most of the time there won't be. I don't like to do that because then you get to be a very busy person if there's a big day with multiple trades, you have to manage them all. Okay, let's look at a trade here. So I'm doing this quickly without all the analysis that I would normally do, and without my guidelines in front of me. And by the way, on that, even I print out my guidelines and I look at them every time. It's like flying. Many of you know I fly a lot for fun in small planes, and every single time when you start the motor or when you're coming in for landing, every single time without fail, you read the checklist and make sure you follow it. And I believe in that. So SPX is at 4180. Let's just start by picking a debit spread that is at or just below the money. How about 4185? Oh, that's not good. How about 4180 and 4160? Let's try a 20 wide and see if we can make it work. Normally we do 25.
So while you're looking at that, let me just mention that the G tool or the B tool, whatever Tim's going to call it, B tool sounds pretty good. I've had a chance to see a couple of the runs there, and I have to say I was actually quite surprised because there are some good candidates where the debit spread is actually more than just 1 or 2 strikes out of the money. So when that B tool becomes available And I don't know how Tom is going to price that, or if it's, or what he's going to do with it, but I would recommend it because
It'll probably be something similar to the old G Tool pricing. It was like $30 a month or 300 a year.
I think it's money well spent. It's going to save you a lot of time and you'll be able to rank these things. But for the current purpose, whatever Tim chooses here, it's going to be a good spread. And if the B tool was available, there might actually be a better one that would percolate to the top better than the one that Tim and I would pick by the seat of our pants. But
Yeah.
whatever Tim picks will be correct. So pay close attention to what he's doing. I'll shut
Okay.
up.
Okay. Well, no. Thanks, and I appreciate it. Again, for just starting out, I'm looking for about 20 delta on the short put for the put credit spread. So I'm going to pick 40-60, and we'll make it the same width, 40-40. This is starting, okay? Both of these, we may tweak these strikes. 40-60 and 40-40. There. And then I'm going to make 2 put credit spreads to 1 debit spread. This is what I will be calling an analytical unit. And it's the starting point for analyzing if you've got good strikes and pricing and everything as we go through our guidelines. All right, then I'll take a look at this and we'll see. Now, normally, this looks like a normal entry of a boxcar. You've got the upper line a bit below 0, but not too far. You've got the market price right near the top of the tent, sometimes just above it a little bit, and that has to do with where the debit spread is located. And you've got your put spreads down here. And we always like to have them be more than a standard deviation away if we can. And let me set that up. So this is 19 May. So I'm going to set this to about maybe May 17th. And you can see right away from the gray area in Thinkorswim, these shorts are not more than a standard deviation away. So we might want to be thinking about putting them a little bit further away. Before I do that, we'll take a look and see what else we have here. One of the biggest and most useful guidelines that we have is this, what did you call it? It's CS ratio, I think, or
I just call it the credit spread debit spread ratio. But Tim, this is your service.
Okay.
Name it whatever you like for the sake of simplicity.
Okay.
You could just call it the ratio, whatever you want to call it.
Okay, I'll have to figure that out because I have a tough time remembering C to D or whatever, but we'll figure that out.
Yeah.
You need to do that. I'm just doing this quickly, of course, but you need to look at the components. And so the first component is the maximum profit on the credit spread, okay, which is this line right here, and we're seeing $490. Okay. Then look at the total cost of the debit spread, which you already know what it was. It was $1,400, but we'll read it off the graph. It's $1,295. Is that right? No, I'm reading it here. 710. Yeah.
Yeah.
710. And divide those two out, and I get 69%. One of the strongest guidelines or parameters that I don't want to blow is this needs to be 60% or greater, and maybe not more than about, I don't know, 80 or 90%, something like that. We're picking the parameters on that.
Tim, you might want to work with Gary because this could easily be incorporated into the B tool.
Yes, and I think he's planning to do that.
Because he's going to have these numbers, and so probably the next question: how did I come up with, or how did Tim and I come up with that 60%? Well, just empirically, but also common sense. In the sense that if the ratio is really low, like say 50 or 45%. You're paying a lot of money for that debit spread, and that means you're going to be bucking a headwind. Tim's a pilot. I used to be a sailor. If you have to tack into a strong headwind, you're going to have a rough ride. So it's the same analogy here. Um, Conversely, if you have a super high ratio, you're not going to be adequately hedged out by the debit spread. So what I like to see is somewhere between my personal favorite is somewhere between 65 and 80%.
Yeah.
But this is a reliable metric. And once again, it's mathematical, obviously. It's true because, as everybody knows, the expiration lines on for any kind of option strategy with the same expiration date, the expiration lines are mathematically true. So in other words, whatever the maximum that you reported on the credit spread, that is in fact the maximum that could make, mathematically true. So this is a useful metric, I think.
Yes, extremely useful. Right. Okay, so this meets the initial analysis. This could be a possible trade. And I guess I would say, note the margin that it's saying. This is a Reg T account, by the way, 2,000 in margin. But if we end up taking off debit spreads, and I'll just uncheck this one for a second, you see it goes up to 4,000. So you do need to plan for the maximum margin you use during the trade. So from here, what I would do is I would say, well, how big a trade do I want? And I might go up to 4 debit spreads and initially look at 8 credit spreads. It's still a 2-to-1 ratio, but now it's a bigger trade. We've got more margin, we've got more bigger numbers, but the same relative numbers are there, and that credit C to D ratio is going to still be the same just because we scaled it up. Then I would take a look and see, well, does it still work if I do maybe one less, or if I change this ratio slightly? And many times it does still work, and that reduces your margin and changes things a little bit. But just like sailing, that's a good analogy, Dan. When you're flying, if you have a strong headwind, or you start changing the parameters of the flight, you have to adjust to it, and you have to manage it. So it's just like flying in these trades. You have to handle it when conditions change.
Tim, could you punch up the day step, say T
Yes.
plus 7 or T plus 10?
Yes.
Since this is going out to the 19th, once you, if you will, try T plus 10.
Do you do,
and,
okay.
For the sake of simplicity, if you would just make it a 1-day step instead of the plus 3, make it a 1, because I wanted to point out one of the things I'm working with Gary on is, you see the hump at what I call the hump at around 41.30. I mean, I know you do, Tim, but I mean everybody.
About
So
here.
yeah, so where Tim is pointing, this is what I call the hump, and this is the hypothetical profit that you would receive at T plus 10 maximum, which, as you read off there, is $751. Now the magenta line, that's the loss that you might expect, possibly someplace along that line, at T plus 0.
Mm-hmm.
So in other words, now. So if we suddenly dropped. So I'm working with Gary on incorporating those metrics, which will hopefully be incorporated into the B tool.
Right.
The other thing, Tim, you may want to talk about is the confluence point down there.
Oh, right here and up here somewhere.
Yeah, those are the avoid areas, obviously.
Avoid areas, right. Confluence simply means basically when these two lines get close together. And I know that's subjective, but like here, they're relatively not close together. Here, they're pretty close together. So somewhere in here is where we would say the confluence point. And we could invent some number metrics on that, but definitely the confluence point is either at, you would make your adjustment at that, definitely, and likely a little bit before that. So that's one way to think about where your adjustment point is. Down here, I wouldn't let it go this far. I'd be looking at when this trails off a lot. So it starts to trail off or turn down, you know, a lot right about here somewhere.
Yeah, that's exactly what I do. As soon as that, as soon as the slope of those lines, which are hypothetical lines, of course, those are not mathematically true, but they're relatively accurate.
Yeah.
And as soon as the slope starts to turn south, um, I'm going to make a significant adjustment. But what I usually do, and I don't know, you may do this a little bit differently, but I start to peel one or two before them. That's
Yes.
going to save your bacon. And
Yes.
Tim, that'll be up to you to determine. I think Gary is maybe working on that a little bit, but
Yeah, he's building in some metrics as to when might be a reasonable point to start peeling off.
yeah,
Yeah.
from what I've seen of the preliminary runs of his V tool, I think it's going to be great. Personally, I hope I get a free copy because I'd like to see it. I'd
Yeah.
like to use it.
I'm
Yeah.
sure that can be arranged, Dan.
Yeah.
Great, thanks.
Yeah, me too, because I want to use it as well. But it's going to be an excellent tool, and especially as you get into these trades, it'll be, I'd say, almost indispensable. You know, if you've done a couple hundred of these, maybe not so much, but right. Okay. Let me see here. I want to go back to the chat and the questions from it because we've got a lot of them. Try to catch up, and then we'll talk about this some more if you want. Guidelines, will they be able in written form? They will. I don't have a document I can post right now, but I will be writing that up and I'll be posting it, so they'll be in written form. Remember, there are guidelines, but it'll be my checklist that I use every time I do them as well. So, of the 34 trades, how many winners? Okay, I can do that, but let's hang on a second. Very excited to learn this way. Yes. This is educational service. I want to teach you everything I know about doing the boxcar, and maybe Dan, you can join in once in a while and add things in too. I would love that.
Sure, I'd be delighted. It won't be every time because I'm sort of a retired old guy now, but I
Yeah,
will certainly be glad to and enjoy popping in from time to time. I've known Tim a long time. We've had lunch together, and he's an excellent trader, and I have every confidence that the subscribers are going to be very pleased with his service.
cool. New trades on Fridays or different days. It can be different days. There's no particular reason why Friday. What I really want to do is put them on when there's an advantage or an edge, and typically that's when there's a down day in the SPX or the Russell, whichever index it is. So if we get a big down day, I may decide to open a trade that day, whatever, it's Tuesday or whatever, if I can do it and not have multiple overlapping trades too much. So many questions. Yeah, right. Okay, let's go on down. Start. Okay, we just talked about that. Would the B tool require a TOS account? I don't think so.
No.
No, that's a standalone report.
Yeah. Okay. PCS as a percent of the PDS would give me the break-even point if the price begins moving higher. Essentially, that's that ratio that we just talked about.
Well, it's not going to calculate out to give you the break even, but mathematically that would be an approximate. I mean, that would give you an approximate estimate. But remember, the ratio is calculated from the expiration curves, which are mathematically true. The hypothetical, intermediate day step curves are not mathematically true. They are hypothetical curves.
Right.
But using the ratio sort of indirectly gives you information regarding the break-even points, so that, let's see, Tim, if you would go back to the expiration line, and I think I can answer that maybe a little better here, or the expiration curve, I should say. So if the market, we'll say the market went to 42.20, 42.20. You
42.
would
Right here.
lose at expiration, whatever that says, 900 and
940.
940. If you did nothing else, if you lapsed into a coma, you would lose 900. I guess it says $860. You would lose that. But you see, this trade is managed such that that doesn't happen. And on the downside, again, if you lapsed into the coma and the SPX went to 4020 and you did nothing, you'd lose a lot of money.
8,900. Yeah.
That's not going to happen.
Right.
Because there's going to be contingent orders in place, or there should be, and the trade, this doesn't require a lot of adjustments. It doesn't even, I don't usually have to adjust it even every day, but if I do, it's only once a day. It doesn't require all that much, particularly if you have the contingent orders in place. Tim, what's your feel on that? Is that correct, you think?
I completely agree, although the first upside adjustment point might be not too far away sometimes, and so you might be making it pretty soon after opening the trade, but otherwise it shouldn't be that much.
So see, once you begin to peel off, we'll say in the example that Tim just gave, once you begin to peel off a debit spread, that's going to rotate the curves. So that's going to raise up that right side. And that's what keeps you out of trouble. And what I've found so see how that did that?
Yeah.
And that also cuts your Greeks. It makes your delta happy once again. It may raise your gamma up a little bit. It'll drop your theta just a little bit, but much less than if you had allowed that debit spread to take its full loss. So that's the management approach here. Again, it's the balance between the money that you received as a credit and the money that you paid, and what you net out with. That's going to be what you take home. And I would say in the 2 years or however long I've been doing this, this is my favorite trade. Obviously, I'm biased, but I rarely. Well, number one, I have a high win rate, and number two, when I do lose, I don't lose much because I actively manage this, and then I just say, okay, I lost a little bit on this one, but hey, guess what? Rinse and repeat. I just do it again.
Yep. Right. Okay. I just took a quick look at my history, and out of those 34 trades, I've had 7 losers, and so I guess 26 winners or something like that. Biggest loser was $1,200. That's probably because I messed it up. But again, a lot of these were under slightly different or fairly different guidelines. So, the trade's evolving. But I have net positive result, and like Dan says, rinse and repeat, keep going. Do we need any specific conditions to create a profit? I would say no, but if VIX was 35 or 40, I'd probably be staying out of the market for a little while. You could do it, but when that's going on, things are crazy wild, and you might have better results if you just stay out for a little while.
Well, I would agree. And by the same token, when the VIX is really low, you won't get as many jelly beans for the trade. But since, again, this is I hate to keep saying this, but again, since this is a mathematical trade, you should still make money. And it likely won't move around that much. So really the only time that I would avoid this, and I really haven't had to avoid it much over the last 2 years or so, is, as Tim mentioned, in periods of super high volatility. And then I go to full-time day trading so that I don't hold anything overnight, and I try to make my money on on futures and day trading SPX options.
Yeah.
But what I like about having this running in the background is that even though it's not a set it and forget it, it is minimally labor intensive, and it has a super high win rate, and it has a good profit factor, average win, average loss, and it has a good Sharpe ratio, all the metrics that people use. This one fits it, I think.
Yeah. Yep.
Tom, what do you think? You haven't said much here.
Oh, I'm just trying to let you guys go, but it's a great trade, very popular. Like you said, it has a good expectancy, good win rates. It's a solid trade. Doesn't take a lot of adjustments. I think Tim and Dan, what would you estimate on an average trade? How many times do you have to touch it during the life of the trade?
I guess I'll say twice. One thought is if you're having to adjust it more than that, then it may fail anyway. You may just want to get out and go on to the next one. The more adjustments you make, the harder it gets to make your profit target usually.
Yeah, that's basically my experience. Now, so what I'll do is I'll have the contingent orders in place, and what I do personally, although I wouldn't necessarily recommend this on a smaller size, what I do personally, I'll have 2 contingency orders sitting there on each side. So, but see, I do like 10 lots. So I'll have an order to pull off 1 or 2 at a fairly early trigger point, and then I'll have another one slightly beyond that, and the same on the opposite side. And so to answer the question, when those are hit, if they're hit, and it'll be automatic, I completely reassess the trade. And as Tim suggested, I try to make a determination of whether I still want to be in the trade or not. And what I use to answer that question, I look and see what my current loss is, and then I look and see what a reasonable profit would be. And when I say reasonable, I don't mean maximum. I mean a reasonable hypothetical profit. And if I see that even though I have a small loss now, pardon me, that even if I have a small loss now, if I make the determination that I have a good chance of making a decent profit, not as much as I would have, but a decent profit by staying in the trade, then I will stay in the trade. But if by contrast, just as an example, let's say I'm down $300, I'm just making this up, and I see that reasonably my only chance would be to make $200. I'm either going to get out of the trade or I'm significantly going to cut the size because it's not worth it anymore, right?
Yeah, that's right. Or there's only 2 days left or something, probably not worth it. Okay, we got a lot. I guess I'll keep going for a while. And would you start with negative delta? Yes. Well, one of our guidelines is a delta range that we start with, and I believe right now we're using minus a position delta, not a individual delta, of minus 1.5 and positive 0.5 or something. We may tweak those, but the G tool or the B tool is actually going to report that as well. What is the initial delta? And you can use that as a ranking method amongst all the candidates. Let me scroll down a little bit. Down guideline because of potential increased volatility in premiums. Well, it's a mathematical trade, like Dan says, and you need to balance out and basically take off losers and keep winners going. I always say mantra to downside is buy puts and sell calls. Okay, that sounds real simple, but there's many forms of doing that, and buying back some of the put credit spreads that you sold is a form of buying puts. And so that's exactly what our downside adjustment is. The premium on that put credit spread goes up really fast when we have a big down move. Learn more about Boxcar Trade Entry Management. There's a fair number of recordings out there. I guess I'd have to make a list. I've talked about it a lot in the beginner group. I think we've talked about it a lot in Trading Group 1. There's this service where I plan to put out a lot of information. Don't know what else to say about that.
No, I mean, this is not written in a book, if that's what you mean, because I never wrote anything up, and
Right.
and nor do I intend to. But yeah, there's a lot of recordings out there, but
Yeah.
and you may want to look at a couple of those. I don't know that I would be spending, unless you're a lonely person, do not spend your weekend doing this. But I'd watch a couple of those, and then I would really study. I mean, this is just my recommendation. I would really study the guidelines that Tim is going to put out and try to get a sort of a conceptual feel for the structure of the trade. Not only in terms of what could happen negatively, but why the trade works most of the time. For those of you who have ever read about positive expectancy, you know that it's possible, and in fact, many people like to trade the straddle, and they may have a win rate of only 30% on the straddles, but when they hit it big, they make really big money, and it balances out. Well, the expectancy numbers on this trade are radically different from that. For this one, the win rate is high, and we need to keep the average win greater than the average loss. And if you do those things, you're going to have positive expectancy and you'll be happy. So that would be the way that I would approach this, rather than spend many hours looking at stuff. I would try to understand the reason the trade works. What do you think, Tim?
I completely agree with that. And I would add that a good understanding of credit spreads and debit spreads in general, is basic knowledge and you should understand how they work because this is simply a combination of the two. And there are books on that. There's lots of stuff in my beginner group. I've talked about that extensively over the years. That's foundational knowledge that you should have when you're doing this or almost any other complicated trade.
Well, I would agree, and I think we can illustrate that, Tim. If you uncheck everything except the debit spreads, okay, now you're seeing the graph of just the debit spread component, and the line in the center. This is where we are now. So notice that if the market suddenly went up to 42.20, you'd lose nearly one half of the money that you paid. Now, but the thing is, those curves, if you want to punch up the day step and have like a 1 or 2 thing, so I would study the relationship of these curves. Notice that over time, this debit spread also loses money, but we know that over time, the credit spreads make money. So I would spend some time studying the way these credit spreads and debit spreads work mathematically, as individual trades. So another example, notice that once you get up to, we'll say, down to 41.30, notice that the slope changes. The slope is not rising as steeply. That means the debit spread is not making as much money as it did. So while the debit spread would have made a lot of money, your credit spreads at that same point are losing money. So I think it's a good idea to study these individually. I do it almost every time anyway, and see where they're going to be making and losing money. And that will give you a visual representation of the way that the trade is going to play out.
Yeah, for example, here's the credit spread component. The graph is different, but it's the same idea. You can see where, you know, where this one starts to lose a lot of money, and the slope again changes the further down you go. That's all important to managing this trade or credit spreads in general. Okay. On a single tranche, what would be the average profit? So we have, okay, so I can talk about this for some time, but quick answer is I think it's about 5 to 7% unless you've made adjustments. And if you've made adjustments, then I would start reducing that to maybe 3 to 5%. And if you make 2 or more adjustments, you might reduce that to 0 or 1% because adjustments get hard. That's kind of how I look at that.
Yeah, those are my numbers too.
Yeah. And let's see, here's one. In the case of a sudden down move, how about buying the weekly something put spreads? Well, there's all kinds of things you can do in a big move, okay? The boxcar guidelines and the way I'm going to trade this trade don't include some things like buying weeklies in a different expiration or something. That can all be done. You can take your credit spreads here and roll them out to another week and maybe increase your profit potential a little bit. That's all outside the scope of just the boxcar trade. Generally, I won't be doing that. It may be in some of my personal trades that are not going to be in the service. Sometimes I do that, but that's the
that
case.
adds a level of complexity, which I have found is actually usually not worth it. I mean, like Tim said, pardon me, there's a million things you can do here. You know, you can cut and roll, you can cut by half, you can add calendars, you
Yeah.
can add a butterfly, you can harvest the profit of a debit spread and then put on a new one. You can cut one debit spread if the market has moved up a lot. You can cut one or more debit spreads and write it out. But for a service, and I found out this the hard way with the road trip trade service, the more levels of complexity that you add, the more difficult it is not only to follow what's going on, but also to actually wind up with a profit. So it's the KISS approach, you know, keep it simple, stupid.
Yeah.
Not
And
that any of our subscribers would be stupid, but you know what I mean.
and doing all that can turn a loser into a profit trade, but it might not. I mean, it might not be better, you know, than just getting out or sticking with the basic boxcar guidelines. Let's see. Oh, you can't see this. Will I stick to the 5% profit and then get out, or will I ever consider holding it for a larger payout?
Personal choice.
It's personal choice. In the service, I will almost always be exiting if we realize 5% or 6 or 7%. In my personal trading, I've actually expired some of these under certain conditions. You can do that. You might be able to make more. One of my paper trades actually turned into something like 20%, but that's again kind of getting up to what we used to call Pac-Man level 5. Maybe I don't know if everybody knows what Pac-Man is, but
I love Pac-Man.
Yeah, I did too.
Dating myself, but
you're getting up to a higher level of thrill seeking or something like that. Anyway.
Yeah,
Okay.
I mean, one thing that is really easy to do, but this unfortunately does not happen very often, and that is that if you've been in a trade and the market has been running up steadily and you've already pulled off one or two, let's say you had 3 debit spreads, you've already pulled off one, it ran up more, you pulled off the second one, and you are profitable now because the credit spreads are making a lot of money. What I will do sometimes is I will pull off, in fact, what I will do always is I will pull off the final debit spread. Now I'm simply left with the credit spread. And if I only have 1 or 2 days left to go, or even 3 days, I'll watch it, but I may let that expire, and that will give me another percentage point of profit.
Yeah. But as far as in the service, it'll be very rare that I would do that. But it can be a good plan. Okay. I think we're almost caught up. Somebody said, Dan, what is your experience with the rut boxcars? I don't know if you want to
Yeah,
comment.
well, I like the rut. I don't usually make quite as much, but I have had actually good results. I have had positive expectancy, and so I usually will have one of those on. In fact, I was going to put one on this morning when the market was down, but now I won't because I was doing something else. But I like the rut, and so I think Gary is working on that, or will be. Maybe at some point in time he'll work on that. But I like it, and so what I do in my own personal trading, I have two accounts that I trade that I trade personally. I have other accounts, but two that I trade personally, and one of them I day trade the SPX single options and YM futures and the rut. And in the other one, I trade the SPX boxcar. So I usually have both of them on at the same time, but they're in
Yep.
different accounts.
Yep. Okay, we have two more. They're in the Q&A box, so let me jump over that, and then maybe that's a good point.
Yeah, probably need to wrap it up pretty soon.
Yeah, so Gary says, why the boxcar versus many other strategies out there? What appeals to you most? So I'm going to start on that, but you know, there's hundreds and hundreds of strategies that all have been back tested and have guidelines written up, and they all work for somebody. Otherwise, they wouldn't exist. Can they be done with the risk tolerance that you as an individual have? Maybe, maybe not. Can they be done with the kind of volatility of return? Maybe, maybe not. And so it all comes down to what are you comfortable with doing, what fits within your risk profile and all that. So if you have, for example, a trade that loses 1,000 this week and next week it makes 1,200 and the next week it loses 5,000, the next week it makes 6,000, that might have positive expected return, but look at those wide swings, okay? That may not be conducive with your stress level. It's not for me. And therefore, that's one reason why I would choose something like Boxcar or other less volatile of return trades.
I think that's a good answer, Tim. I would agree with that 100%. I mean, you know, if somebody asked me the question, does the boxcar make more money than anything else? Well, no, of course not. I mean, the people who make the biggest money are people who are well capitalized, and they'll just buy or sell futures. And if they're down $25,000 on one day, so what? Because the next day they might be up 50,000. Speaking for myself, we're not that well capitalized, and so I have no intention of doing that. But from a risk to reward perspective, I have found that the boxcar suits me very well because I'm able to control what's happening to a certain degree, as much as is possible within a market situation. I'm able to control what's happening. I don't really worry about holding this trade overnight. There are very few other trades that I'm comfortable holding overnight, but this one doesn't worry me. And yet I make a reasonable return. I don't make, 20%. I have, and so has Tim, but that's vanishingly rare. But just like on the trade I mentioned earlier, made nearly 9%. Usually I'm in the 5 to 6%, pardon me, 5 to 6% range. And I do that at a sustainable comfort level. So I would agree with Tim on that one.
Okay, yeah. Okay, and let's see. Victor, I guess, has the last question, I think. Smaller accounts and doing a 1x2 trade and aren't able to peel off. We still probably, well, I can talk about that, but the ability to peel off some of your debit spreads, for example, but not all of them in one shot is kind of critical. It allows you to manage this trade without taking such a big adjustment. Now, I guess I don't recommend doing this trade in a 1x2 lot. However, you can do thinner spread widths and still control your margin. You know, Amy was doing even five wide spreads, and that'll keep your margin really low. There's other tricks that can be done that might work, but not as well, like using IWM or SPY. I guess I can comment on that in the service, but I won't actually
No
be
money
trading
there.
that way. There's very little money and high
No money there.
commissions. Yeah.
So, yeah, Tim is exactly right. If you want to trade with a smaller margin, you need to narrow your spread widths because you do need to have the capability to pull off a debit spread. You could have a 2x4, that's no problem. But if you have a 1x2 and you pull off your single debit spread, if you have several days left to go, I don't think you'll be happy, because if the market takes a sudden downturn, now you got your pants down and nobody likes that.
Yeah. Okay.
I did see one question about giving a heads up. That's kind of the normal way most experts do it, is they'll say, here's what I'm going to do. Here's my working order. Send it out to you. Then they transmit their things. We don't front run. And then, once you get filled, then there's a second message that here's my fill prices.
Yes, exactly. My initial alert will come out before I make the trade. Here's what I'm going to do. Here's the prices, all that, right? And then when I get a fill, another one will come and say, here's my filled price. That's exactly right. Okay, well, give a heads up. Yeah, I want to get a trade going. I guess I could do it at any time. So I'd like to get one going by Friday. So watch for that. And I guess I'll start doing it now.
And then I guess Masood asked, what's the margin required or recommended?
Per trade.
Or per account?
Per account.
That's a hard question, isn't it, Tim? I mean, because this is scalable.
Yeah.
I guess the minimum viable account people should have before they consider subscribing.
Well, I'd probably say at least 5,000, preferably a little more. This trade will be smaller than some of the other services out there where you need 50, 30 or 50, but I'm going to plan for each trade to be a little bit less than that. I don't know.
Yeah, you can certainly do it with 5,000. I think you'll be a little happier if you were able to commit, say, 7,500 as your minimum, but it's possible certainly to do it with 5,000. You'll need to narrow your spread widths. So they'll be different from the ones that will come out with the B tool. And for people that are unfamiliar with this type of strategy, you might want to start with a small account, and then if you're happy with it, and once you see how the trade works, begin to scale that up.
Yeah.
And I think the pricing, Amy was doing $99 a month. Are you happy with doing that, or you want to change it, Tim?
I see no reason to change that at this point. Yeah.
Okay, yeah. Let me just pop in the URL. If people are interested right now, they can just go right here and sign up.
Yeah, and but see, that's actually another consideration. If for the people who can scale up their capital just a little bit, they'll be happy with that 99 a month. That'll be no problem because they're making good money. But if you find out if you're trying to trade this with $3,000 and for 1 month you make 150 and then you're writing the check to Tim, and then you say, wait a minute, Tim gets $99 of this. But if you're making a couple thou a month and you write the check to Tim, you'll just say, thanks, Tim.
Right. So I think, Tom will talk, but I think for new subscribers, we might give discount for the first month or something.
Yeah, that's how it's set up now. So if you're new, it's 50% off for the first month. If you're already a subscriber, you don't need to do a thing. Just keep your subscription going. It'll just still say Boxcar, and instead of Amy getting the share of the sale, it'll start going to Tim. But as far as you, the subscriber goes, nothing's going to change. Don't need to unsubscribe or resubscribe or anything. Just keep it going.
Yeah.
Right,
And
and
then-
Tim's going to send me a gift card to Chili's. That's what I get out of this.
Absolutely,
So-
Dan.
So
Probably.
I'm a freebie. Whenever I show up, I'm a freebie.
Yeah, absolutely. You got it. You got it.
Okay, and then the pattern day trade rules, I guess that's a player if it's less than 25K, right?
Now that could be a problem. Exactly. The rules are if you make 3, I think, or more than 3 day trades in and out and on the same day with the same security, basically in a week, then they restrict your trading. There's no good way around that. That's an SEC requirement, not a TOS requirement. And so if we have a trade and we have to make, more than 3 adjustments in a week, or if we go in and out in the same week, that will all count against your 3.
I guess one way around that would be to trade futures options. So if you're doing SPX, you could do ES options, and there's no pattern day trading rule for futures options.
Ah.
So that would be a workaround.
Yeah.
But the
All right.
commissions will be higher, of course.
Yeah. So there are trade-offs, of course, but yeah, that is an alternative if you're worried about it.
Yeah. So I guess I would say, well, thanks everybody. We've had a lot of people on here today, a lot of great questions, and Dan, thank you for joining in as well.
Oh, you bet.
Give if you're already in the service, give it a chance and see how we do. If you want to subscribe, I think it can be a good service, and there's a discount type thing. And I'll work as hard as I can to help everybody out, teach you, and also make trades.
And I think Rami says, can this easily be translated into ES option trades? I believe so. If you're doing SPX, it should be a simple no-brainer.
Yeah. That's not something I've looked at yet. So
Yeah, you
No.
can do it with the ES. It would be more difficult on a rut trade, not impossible, but much more difficult.
Yeah.
But you could do it with the ES. Yeah, that would be easy. Obviously, as someone mentioned, Steve, great trade for a retirement account. And as I said, I do one in a margin account and one in a retirement account. And so the retirement account, there's no pattern day trader rules. And fortunately, my margin account is greater than 25,000. So I'm never hit with that, but that is a problem. And for example, like I mentioned, I day trade, S&P single options. Well, I'm in and out of that one, obviously, maybe 2 or 3 times on the same day. So if I didn't have greater than 25,000, I would be hit. So that is something you have to consider.
okay.
All right, everyone. Well, thanks for coming. Again, if you do have questions for Tim at aramir.com, email. We can get questions answered. I'll again post this as soon as I can to the library and to YouTube. If you aren't subscribed to the YouTube channel, it's free and you can get notifications there as well. So now feel free to do that. And again, Tim, looking forward to you taking over. And Dan, thanks for the assist and the extra nice words about the Boxcar and advice for everyone.
You bet.
Oh, and I guess somebody's asking for the URL again. Here's the, oops, I added a plus there accidentally. Sorry about that. That's the URL you need to go to if you want to sign up right now. So again, thanks everyone. I will get this out as soon as I can, and we'll see you all next time. And good luck with the service, Tim.
Okay, we'll see ya.
Thanks, everyone.